Hello guys, welcome to another class, and in today's class we're going to be talking about chart patterns. Now, first of all, you need to know that there are three basic classes of chart pattern, or three basic variety, or chart pattern can be broken down into three different classes. And we have reversal patterns. So reversal patterns are used to get reversal of a particular trend, because it's all surrounded around trading a trend, or the market as a whole is about trading trends. What I mean by trend is either the market is moving in a bullish structure or a bearish structure. Now, we have reversal patterns, we have continuation patterns, which is going to tell you that the market is going to continue in a particular trend, and we have bilateral patterns. Bilateral patterns is a situation where we don't know if the market is going to continue bullish or it's going to continue bearish. So we're going to go to the first one. The first one is what? Reversal pattern. For reversal pattern, we have what? We have double top, we have heads and shoulders, we have rising wedge, we have falling wedge, we have inverse head and shoulder, we have double bottom. Now, if you take note, you realize that each of these patterns are divided into two distinct types, one for a bullish scenario and one for a what? A bearish scenario. So double top is a reversal pattern. Let's say the market is going bullish like this. We want to see something like a double top here, and the market break out the neck of this previous low. So we call this area where they are almost two equal high, or basically two equal high, then the break of a previous low. We call this a double top pattern, and it's used to identify a reversal of a bullish trend. It is used to identify the reversal of a bullish trend. The same thing, we have heads and shoulders. Heads and shoulders. So for heads and shoulders, in a bullish trend, so we have the market trending like this, we want to see one candle break above, come back to the neck of, or to the low of this previous candle, then want to have the market break, want to have the market come back to the area of this previous high, come into it, then start breaking below. So we enter after the market has broken below as our entry, then our target could be at this previous low around here, which makes it an head and shoulder. So we have two shoulders and we have one head. That's what makes up an head and shoulder pattern. Then we have rising wedge. Now, in a rising wedge scenario, we have where the bullish momentum is beginning to weaken out. So we have the market keep going bullish, but it's struggling to continue going bullish. There are less entries coming into the market, so we form something like a wedge at the tip of the bullish trend. And what happens is that the market now starts breaking the last low and selling towards the end of this area. So we call that a what? A rising wedge pattern. So we want to enter at this area, according to, you can see it all here, and sell all the way down to this area. Vice versa on this double bottom, inverse head and shoulder, and falling wedge. For these ones, we are using, it's a bearish scenario that wants to change into a bullish scenario. So for double bottom, we have double bottom here, then the market breaking above the neck of this double bottom. We'll put our stop loss here, our entry as the market breakout. So we can even say in terms of trend line breakout strategy, we start seeing a double bottom at the end of the trend, and we want to enter here, and our take profit could be somewhere around the next high or the previous high. Then same thing with inverse head and shoulder, same thing with falling wedge. For example, we have the market falling and getting low momentum as it's going down. We want to see the market breaking out of this wedge, maybe breaking this previous high and breaking through it. So we want to put our entry here, take profit around here with our stop loss at the previous low. So that's that for all reversal patterns that we have in trading. So one thing you can do is you can take a screenshot of the reversal patterns, so that whenever you see them, you can, and you are a pattern trader, you can now choose to trade based on these patterns and catch your entries based on this pattern. So if you are expecting a reversal at a particular point, you want to look at for double bottom, heads and shoulders, or rising wedge. If it's a sell scenario, you want to look out for double bottom, inverse head and shoulder, or falling wedge. So the first one is double top. Then we go into continuation pattern. For continuation pattern, we have what? We have falling wedge, we have bullish rectangle, we have bullish pennant, and we also have rising wedge, we have bearish rectangle, and we also have bearish pennant. So just like in reversal pattern, the top one here are for bullish scenario and the bottom one here are for bearish scenario. And what do we mean by continuation pattern? We mean that if the market is going in a particular trend, for example, the market is going in a bullish trend, we want to see the market doing a falling wedge like this, and from the falling wedge we want to see that the market breaks out through the falling wedge, through this high, and continue in the already existing bullish trend. Same thing, bullish rectangle, we want to see the market go high, forming a kind of rectangle within a support and resistance level. Then we see the market breaking through this resistance level and forming a rectangle pattern. We want to enter here and take profits at a significant high. But there are rules behind this. For example, in a falling wedge, we want to use the whole of this wedge, from the beginning of this wedge to the end of this wedge, as our full trading area. We enter at the breakout of the wedge, our take profit is at the previous high, and our stop loss is at the previous low. Same thing, we want to use this area to this area. We want to calculate the length of this rectangle, bring out the length of the rectangle, equate it to the next high, enter from wherever the rectangle breaks out from. So the same length that happened within the rectangle is, we want to carry that length and take it and use that length as our take profit target, our entry target, and our stop loss will be below the last low. So again, we have bullish pennant. So for bullish pennant, we have the market coming out of a bullish direction, then forming a kind of trend that is squeezing. So we have the trend squeezing in on both ends. So we want to see the market break out of this area, forming a bullish movement and going in the same direction. For the bullish pennant, we want to calculate from the beginning of the pennant to the high of the pennant. We want to take that length and use that length as our profit target, where we now target the exact movement of that length, and our stop loss becomes the previous low. Vice versa for the scenario of a bearish structure. So we want to see the same thing but in reverse on a bearish structure. Now finally we have bilateral patterns. So you can see that bilateral pattern is a little bit like bullish and bearish pennant, but the difference is that for the bilateral pattern, in the movement of the candle, you want to see a resistant level. So we now have a resistant level at this high. The market is trending from the low like this, but it's hitting within the resistant level. Now what does the bilateral pattern try to tell us is that in a bilateral pattern, we don't know if the market is going to break high or is going to break low. So we want to set our entry as a stop order. If it breaks, either way it breaks, either low or high, we want to be in the trade, trading the bilateral pattern. That's what they explained here. The same thing with this explanation. We have the trend line here, the support level there, we have the trend line here. If the market breaks out from any of the both of them, we have our entry there. We have two trend lines squeezing from a very huge movement. So in a pennant, the difference between this symmetric triangle and a pennant is that in a symmetric triangle, the difference between the trend is a very wide distance. Then the market can choose to break out from any area of the trend and hit our target. Our target will still be almost the same thing. We calculate the length of the first triangle, then we take that length and we put it up here as the length for our target profit. So that's that for the various chart patterns that we have. You can take a screenshot for anyone. If you are going to be trading chart patterns, this is what you want to know. So let's go into the chart and let's see how we can pick at least one or two chart patterns just merely by looking at the chart and be able to understand where the market will go to after that chart pattern. So for example, we have, this is still Euro USD. We have different chart pattern happening here. Now we can see in this area we have a continuation of this bearish flag chart pattern. We see the market trend ranging in this area. So if we take the distance of the market from here to here, we can see that when the market finally broke out of this area, the market was able to cover that distance. Let me zoom out so in case you're not seeing it clearly, you can see that the market was able to cover that area as the market was going down. Now this is for a bearish rectangle pattern. So we want to enter our entry as the market begins to break through. Sometimes we might have the market breaking through and rebounding to touch the low or the previous support turn resistance. Our stop loss above the previous low, our take profit just within the length of this, and we have about a 1:1 risk to reward, which is a very good trade, confirming that the market is following our bias. And we can also see here that we are having another sort of rectangle around this area. So you can see the sort of rectangle around this area. The market broke it, and you can see, I told you the length of the rectangle. This is the length of the rectangle. If we pick the length of the rectangle, you see that the market was able to fill the length of the rectangle. So if we had entered our bullish entry here, our stop loss below there, you can see this is a very good 1:1 risk to reward, and would have hit take profits easily. Now you can see here we have a double top pattern serving as a reversal. You can see the market went up, from one top, came back to the neck, formed another top, and started breaking out the neck. So this is the neck. We want to enter the trade. We'll be entering like this. We want to enter as the market breaks the neck of this area here. Our stop loss above there. We look for the movements of the market in terms of this, from this neck to this eye here. We take that length, we put it down to the market, and we will get a very good 1:1 risk to reward trade. So you can see how an example of double bottom just happened here. Then we can see this pattern forming a rising wedge pattern, and we have the rising wedge here. We have the trend line down here. We have the support or the resistance level up here. So in this rising wedge pattern, you can see how the market is breaking through this rising wedge. If we had put our stop loss above the rising wedge, then we take the calculation of this area to this area and we bring that calculation all the way down here, we would have had a very good 1:6 or 1:5 risk to reward trade that would have taken and have been very, very accurate. That have been a very nice trade. Now let's see what more we can find. We also have this bilateral chart pattern forming here. You can see the market is coming all the way here, and you can see the market is forming a resistance level here. You can see the market is forming a resistance level here. So we see how the market broke out of this area. If we were to calculate this movement from here to here, and we bring that movement outside of this breakout, we see that the market almost filled, and in the long run filled the movement. We would have been able to sell from here and put our stop loss above this previous high, take profits at this area, and would have gotten a very good 1:5 risk to reward trade. Then we also have this flag pattern here that is forming here. You can see it also. If you want to trade from here, sell, and if we are to measure our stop loss above here, if we are to measure the distance between these two channels and bring that distance here, you can see that the market will have hit our take profit very easily. The market will have hit our take profit very easily. I would have gotten a 1:1 risk to reward trade very easily. Now we also have this pattern here. You can see this pattern here. So if you're a pattern trader, you would most likely enjoy your trading as much as you are a trend line trader. You can see this pattern here. You can call this a rising wedge pattern or a bullish flag pattern. And if we were to take the length between these two areas and we trade after the breakout, we would have gotten the entry very well. So showing you double top, see another double top pattern here for me here. Double top, if I to take the trade, would have gotten a very good entry. And you can see another double bottom pattern for me here. If I to take the double bottom trade all the way up, would have gotten a very good entry. Then let me see if we can see another chart pattern forming from previous areas. We can see this is more like a wedge pattern happening up here. So you can see the wedge pattern happening up here, more like a bilateral trading pattern. So if we were to take the whole of this area from here all the way down to here, we can now understand why the market went this far when it was selling, and we would have been able to like short from this area all the way down to this level here, and we have gotten a very good 1:2 risk to reward trade easily. Would have gotten a 1:2 risk to reward trade. Now you just need to be able to spot these patterns on the chart. When you're able to spot these patterns on the chart, you can see this falling wedge pattern here. So as the market was falling with this wedge, and we have this low here forming a support level. So if we are to measure from here to this high here, I will take that measurement and we'll put it after the breakout of this wedge. We would have seen that we would have been able to get a very good trade, which would have given us 1:2 risk to reward, as easy as that. You can see how trading becomes simple when you are just following simple chart pattern, but you need to have memorized all these patterns. You can see this area here also where we had this pattern. This is a falling rectangle, and if we were to calculate the distance, if we were to even calculate the distance of the total rectangle, because in the rectangle sometimes we can actually calculate the distance of the total rectangle from the beginning of the rectangle to the end of the rectangle, and we pick out that movement. Like this, for example. We pick out that movement from beginning of the rectangle to the end of the rectangle. As the market is breaking through the rectangle, you can see what happened next. This is not me and picking any strategy. I'm just showing you based on what the market does. You can see how the market flew all the way up there. The market broke through the rectangle. We had a solid 1:3 risk to reward trade. Very good 1:3 risk to reward trade. Now another wedge pattern. You can see this wedge pattern. We have a support level here, and you can see how the market from this wedge broke out of the wedge. For us to pick the length of this wedge from here to here, we see that the market was able to fill the length of the wedge by buying all the way up here. So these are simple things. It's very simple. That's why intermediate trading is something that will help you a lot. Would have gotten a very good 1:5 risk to reward trade here, and as easy as that. The other here also a reversal pattern. So you need to understand if it's going to be a reversal, if it's going to be a continuation, what you are planning, what pattern are you seeing that confirms that this is going to be a reversal or a continuation. We can see all of this happening here, then we can see it here happening again here. So if we were to pick the entire length of this area to this area and we take this to this breakout, we can see that the market did a very even before the market pulled back, the market has already gone and giving us a very good 1:1, 1:5, 1:2 risk to reward trade. Invariably at the end of the day, it gave us a very good 1:2 risk to reward trade after the breakout. So most times these patterns are being traded after the breakout of the pattern. Once you're able to get or see the pattern forming, you trade it after the pattern breaks out, and you calculate the length of the pattern formation and use that length as a target for your profit, and that's that. You are able to get a very good entry. Now once again, let me go again to all the patterns, show you the patterns. If you can take a screenshot to be able to remember them, it will be very helpful for you. And you can see some patterns forming here. Rising wedge. As the market broke out, the market went all the way down, the market came here, formed head and shoulder. Okay, see head and shoulder pattern here. So we have the first shoulder, we have the first neck, we have head, we have the market breaking out of the neck, we have the next shoulder. So this is the head, these are the shoulders of the candle. Then see the market trying to broke out of the neck. So if we had broken out of the neck and you calculated the entire movement from the neck to the head, and you carry that movement and you put it here, you take your entry like this with your stop loss as the previous shoulder, you'd have been able to get a very good 1:5 at most, 1:5 risk to reward trade without even going to your stop loss. Very safe and very simple for you to trade. So among all the strategies I'm going to call, next strategy and next strategy I'm going to give you, you just need to pick one. Most of them are 1:1, 1:2, 1:3 at most. The very best you can get is 1:3, but don't try to go as ahead more than 1:2, and always follow the example that I gave you, and you will get the right entry at the right time. See double bottom or head and shoulder kind of formation, but we have double top here. Here we have something like an head and shoulder. You can see head, shoulder here, the head here came back to the neck, another shoulder, then market start breaking out. If you to calculate the length of this neck to the shoulder and you project it up here, you see how the market went up. And now you can now see that even as the market was going up, the market formed a continuation of this bullish rectangle. And if we are to still calculate the bullish rectangle, we now have double entries. So let's say this head and shoulder, first of all, we're to trade from this head and shoulder. After the shoulder, you can see the market ensure that it hits TP for this head and shoulder first, came back to form the bearish rectangle, and from the bearish rectangle, which is at this distance, we want to calculate the bearish rectangle of this distance all the way up into the market, we now have another entry like this, and we would have gotten a very good 1:1 risk to reward, just easily take home. So you can easily trade chart patterns. Like I said, I'm going to take you back so you can screenshot it to know all the chart patterns. If you're a chart pattern trader, stick to it, trade chart pattern, and I promise you, you're going to get a very good win rate by trading chart pattern alone. If you're able to draw the pattern, allow the market to flow before looking for a pattern, allow the market to flow before looking for a new pattern. Look at all the patterns, this bilateral pattern, continuation pattern, you can take a screenshot. Then reversal pattern, you can also take a screenshot. You know all these patterns, you know when you're looking for a reversal, you know when you're looking for a continuation of a particular trade or a particular trend, or you know when it seems like the market does not know if it's going buy or if it's going sell, but you have an area which is either a support level or a trend line, and you're waiting for the market to break out of it before entering your trade. You'll get a very good entry. This chart pattern trading is very, very good and to help you a lot as a trader. So once again, have a nice day, guys.